All right, let's get right into it. In today's explainer, we are breaking down a foundational concept that literally every single market participant encounters, but surprisingly few actually take the time to understand. We're going on a bit of a journey today, starting from the absolute microscopic transaction costs of your very first trade, all the way up to the massive, multi-trillion-dollar engine running the global financial market. So let's dive in.
We've all been there, right? If you've ever traded Forex, or honestly any asset at all, you know this exact sinking feeling. You spend hours analyzing a chart, you confidently hit buy, and instantly, boom, your position is in the red. You're immediately losing money. So why does that happen? Well, it's not a glitch, and no, the market isn't out to get you. It actually comes down to the fundamental plumbing of how prices are quoted and executed.
Here's the roadmap for this explainer. First, the two-price mystery. Second, the bid-ask spread. Third, calculating your trading costs. Fourth, what makes spreads change? And fifth, inside the global market. We'll start with the basic mechanics before scaling up to the big picture.
Starting with Part 1, the two-price mystery.
Here's the thing. Whenever you enter a financial market, you're never just dealing with one single price. It's always a dance between two, a bid and an ask. The bid price is the absolute maximum a buyer in the market is willing to pay. So if you're looking to sell, you're selling at the bid. On the flip side, the ask price, which is sometimes called the offer, is the lowest price a seller is willing to accept. Meaning, if you're the one buying, you have to pay the ask price. And the golden rule to remember here is that the ask price is always higher than the bid price.
Now here's the kicker. Think about the concept of the midpoint. When you look at a standard price chart on the news or your basic trading app, you usually just see one line, right? The quote-unquote current price. But the truth is, you actually never trade at that number. That number is just the theoretical midpoint, the average between the bid and the ask. In reality, you always enter at either the lowest price sellers are asking or the highest price buyers are bidding.
Moving on to Part 2, the bid-ask spread. So the spread is the actual mechanism that bridges the gap between those buyers and sellers. By definition, it's just the physical distance between the bid and the ask. But conceptually, it's so much more than that. This gap represents your built-in transaction cost. Our source material highlights that the spread essentially acts as an order processing cost. It is literally the price you pay for liquidity. It's the premium you hand over to the market maker for the convenience of executing your trade right now, without having to wait around to find a matching buyer or seller yourself.
To see how the pros actually view this, picture an electronic spot trading platform used by interbank dealers like EBS. If you look at the layout for a pair like the euro to US dollar, you'll see black digits, say 1.23. That's called the big figure, and institutional traders just assume everyone knows it. Then you'll see brightly highlighted numbers, like a 97 and a 98. Those are the small figure pips. That tiny 1 pip difference between the 97 and 98, that right there is the spread. That is the market maker's edge.
Which brings us to Part 3, calculating your trading costs.
Okay, we know the spread exists, but what does it actually mean for your wallet? Let's do the math using a simple 2-pip spread as an example. Your actual dollar cost depends entirely on your position size, which is known as your lot size. If you're trading a standard lot that's 100,000 units, each pip is worth about $10. So that 2-pip spread, it costs you $20 up front. The absolute second you enter the trade, you are down $20. Trading a mini lot, it's a $2 cost. A micro lot is just 20 cents. Basically, the bigger your volume, the heavier the dollar cost of that spread.
And this totally dictates who feels the pain of the spread the most. Take scalpers, for example. These are traders who jump in and out of the market dozens of times a day aiming for tiny, quick profits. If a scalper makes 20 trades with a standard lot, a $20 spread per trade means they're paying $400 just to enter the market. Swing traders, on the other hand, might make one trade and hold it for a week. They only pay that $20 spread once. So the takeaway here is that your specific trading strategy dramatically alters how much these microcosts eat into your bottom line.
Part 4. What makes spreads change?
You see, the spread isn't some fixed static number. It's a living, breathing metric. Market makers are constantly adjusting it to protect themselves. The absolute biggest factor is liquidity. More buyers and sellers simply mean a tighter spread. But watch out for high-impact news. When major economic data drops, market makers widen that spread significantly to shield themselves from wild, unpredictable price swings. Time of day is huge too. Spreads are at their tightest during the overlap of the London and New York trading sessions. And finally, overarching political or economic risks will always cause dealers to demand a higher premium to take on a trade.
To really see this in action, just look at the currency pairs themselves. Major pairs like the euro and the US dollar have immense daily volume. Because everybody is trading them, the spreads are razor thin, often under one single pip. But compare that to exotic pairs, like the US dollar against the Turkish lira. Because far, far fewer people are trading it, the market maker takes on way more risk, so they widen the spread drastically. We're talking 10, 20, or even 50 plus pips. So trading exotics creates a massive upfront cost obstacle right out of the gate.
Finally, Part 5, Inside the Global Market. Now that we've really mastered the micromechanics of the spread, let's zoom way out and look at the actual machine processing all these individual bids and asks. The scale here is truly staggering. $7.5 trillion. According to the 2022 Bank for International Settlements survey, that is the average daily volume of the global foreign exchange market. Just to put that massive number into perspective, that is roughly 10 times the daily volume of all the world's equity markets combined. 10 times.
And this beast is only getting bigger. Over the decades, this market has seen explosive growth. Between 2019 and 2022 alone, the market grew by a solid 13% to hit that 7.5 trillion mark. Oh, and the undisputed king of this massive mountain of capital? That would be the US dollar, which is involved in an unbelievable 88% of all global transactions. But here's a kind of wild twist. When retail traders think of Forex, they almost always think of spot trading, buying and selling right now on the spot. Yet data from the BS survey reveals that spot trading only makes up 28% of the global volume. The real heavyweight in the room? FX swaps. They dominate the landscape at a massive 51% of global turnover. The interbank market uses swaps heavily to manage risk and fund their operations, which really goes to show that the true engine of this market is institutional, not retail. So where is all this $7.5 trillion actually getting traded? Well, there's no physical venue. There's no single building in New York or London where traders are yelling at each other across a pit. Instead, it all happens in a wholesale tier made up of roughly 2,000 geographically dispersed banks. They are trading 24 hours a day across global time zones via electronic platforms, settling vast amounts of wealth through the SWIFT network without physical cash ever even crossing a border. It's just this continuous, invisible web of direct deals and electronic brokerage systems passing liquidity around the globe. We've journeyed all the way from the absolute basics of a 2-pip spread right up to a $7.5 trillion global electronic network. Every single time you trade, you pay the spread to the market makers who are supplying that liquidity. So I'll leave you with this final thought. Considering that these market makers can just widen the spread whenever volatility strikes, protecting themselves while simultaneously raising your costs, who really holds the house edge when global financial markets panic? It's definitely something to think carefully about before you place your next trade. Thanks so much for joining me on this explainer, and as always, keep learning.